Fellas, you know Degree Cool Rush deodorant, right? Well, last year they changed the formula, and guys were mad about it. One dude even started a petition. So guess what? Degree heard us, admitted they messed up, and brought the original Cool Rush scent back exactly how it was. And it's in Walmart, Target, and other stores now for under $4. So grab some and remember why its cool, crisp, and fresh scent made it the #1 men's antiperspirant for the last decade. Degree Cool Rush is back, and it smells like victory for all of us.
Reality radio for a really great future. We're talking real money.
Hey there. Welcome to the show again. Uh-oh. I think I left
I don't know where that's coming from.
I know where. It was from my FaceTime.
Oh,
I turned it off.
What am I doing?
Oh,
All
my
right, sorry.
gosh. Hey, hi, everybody. I'm Don. Tom's over there. This is Talking Real Money, the place where we talk about money. Is yours off?
Yes, everything's off here.
I just thought I heard
The water as well, by the way.
Yeah,
So,
yeah.
no water.
His water was broken. It's just so we want to help
Joys
you.
of home ownership. Yes. Go
Yeah,
ahead.
exactly. I want to just rent so bad.
Yeah.
I really do. I just want to rent.
Can't wait to make the phone call. My water's not working. You get over here and fix it.
yeah,
Not
I just
try
want-
to find somebody who will actually come and do it.
I mean,
which
we've
is
got, like-
virtually impossible.
We've got 3 dripping faucets, and the plumber is booked till like
Yeah.
2023.
I was thinking of convincing this guy just to live down in the media room, maybe just feed him, keep him there for the
I
next
just want to
issue.
go to high schools all across America and say, kids, you know that plan you had for college? Cancel it. Cancel it.
Because got a better idea.
Go to Fred's plumbing school.
Yeah.
Go to Al's air conditioning class. Go to Charlie's carpentry company. Do something because I can't find help.
Plus, think of all the ties and nice shoes you don't need to buy. So
Exactly. And think about all the student debt you won't need to take on. And think about the the high rates that I'm paying for these guys right now.
crazy.
Oh, yeah. What was your water guy? What did he cost you an
Well,
hour?
it's $150 an hour or something.
Yeah. I mean, I had
And
this.
he did part of it yesterday. He said, I'll be back tomorrow for more. And he started going into the money. I go, I literally don't care. Just get it done.
I had the guy from Sears come out to look at the dishwasher. Sears still has service. That's all they have left, I think, is service. And it was like $187 for a trip to the house.
Yeah, that's about what it is. Yeah, it doesn't matter.
Yeah.
Get out there and do it.
Be careful. There's lots of problems out there, and we want to help you avoid some of those. And we want to help you avoid problems, about investing and saving money and spending money and dealing with insurance companies. Oh, my gosh. They drive me absolutely bonkers, crazy, make me mad. Insurance industry. Here's the thing about the insurance industry. They're always going around saying, well, we can give you a really high return and there's no risk and no commissions. And they're just lying. They're just lying. They tell you these returns. I had a question yesterday on the podcast from somebody who had a whole life policy and they were making like 3.6% on it.
Sounds about right.
And I'm thinking to myself, where are they getting over 3.6% on their money so that they can have a profit? And the only place I can think of is they're buying risky assets.
Well, and this is part of the issue, right? The insurance industry has had a very difficult time this last decade with low interest rates, with making sure they're going to have the money to pay out. This is an astounding number to me. The 160 million individual life insurance and annuity policies, 160 million. And the 260, here's another number, 262 years the U.S. life insurance business has been around. That's longer than we've been in business. But but here's the thing. Because of those low interest rates, because it's been difficult for them to make money, they are selling a lot of them. And guess who is buying up these insurance companies, Don?
Oh,
Take a
probably
guess.
Private flipping equity firms and hedge funds and things like that.
Because they can come in, they can take those same assets and put them in things like, I don't know, corporate debt. They could put them in asset-backed securities. They could put them in things that are risky. Now, how does that make you feel?
Chinese
with both
real estate?
Yeah, how does that make you feel with both life insurance and with annuities that are sold as guarantees? Is it really a guarantee then?
And, the thing about guarantees is when you get a guarantee, like you have a treasury note, 10-year treasury note, And you think to yourself, that's guaranteed. Because it's backed by the full faith and credit of the United States and its taxing ability. That's pretty safe. Pretty safe. Not 100%, but if the United States fails, everything is pretty much wallpaper.
Not going to matter whether you can get the sprinkler system fixed or not.
You're going to be drinking out of those tubes underground going, is there any water left?
Yeah, exactly.
But insurance isn't. Insurance isn't backed by the full faith and credit of anything except the insurance company.
And guess who's looking over their shoulder? The state insurance departments.
Oh, yeah. And there are only a couple of those that are halfway competent. The rest of them are manned or womaned by former insurance company executives who love their old insurance company. 855-935-TALK.
Tom and Don are talking real money.
Want a free copy of my book, Financial Physics? Well, go download it right now at Vestory.com, Vestory.com.
For your real life and real future, Tom and Don are talking real money.
We're talking about your life and your money and insurance right now, and I just really don't trust insurance companies. I have a real problem with them. Not that most of them are crooked, but that there are some that are crooked, and you're not going to know until after the fact that they are. Great example. 2 years ago, a guy from North Carolina, Greg Lindbergh, set up a life insurance holding company. And he went out and bought a lot of insurance companies like Bankers Life, a big insurance company that was kind of in trouble. And he took the insurance company's assets that, by the way, belong to the policyholders. They're the stuff backing your annuity or your life insurance policy. He took those and put them in things like, here's the name of the company, Secured Loan-Backed Funding for LLC.
That was probably paying 15% interest or something.
No, it turns out he owned that.
He bought. Okay, that's good.
And then he used that money to pay for his lifestyle and political contributions in North Carolina till he was arrested and sent to prison. So tons of money, billions of dollars, were lost by shareholders. So what happened to the shareholders in those guaranteed annuities, Tom?
And I think they probably didn't get their money. But, I mean, the other part is still, number one, the guarantee part is worrisome, not just for the reason that you mentioned, is the fact that the guarantees are made, and there's usually a great misunderstanding between what you think the guarantee is and what the insurance company thinks the guarantee is when it comes to annuity products. Number two, wasn't there a large insurance company that almost went busted like a decade ago?
Executive Life.
But
AIG. That's right. Executive actually went broke.
Yeah,
AIG didn't.
I think you and I had to kick in a couple bucks to keep AIG going. So that's not a guarantee. So anytime someone says, well, that's guaranteed, as you said, even government bonds, well, they've always paid you back, but there may come the day when they are not. So I would be careful about signing up for anything like that. The point of the bringing this up today is my personal take is it's going to get riskier because private equity firms are buying out insurance companies. They have a tendency to invest in things riskier than the more conservative insurance companies have for a long time. That was my point.
So bear in mind when somebody tells you they're going to give you a higher than average return and it comes from an insurance product, well, there's a reason it's higher than average because it's higher than average risk. Whether you can see it or not, and certainly whether they disclose it or not, the poor people who got into Bankers Life annuities have so far, and this happened 2 years ago, so far been able to withdraw at most from their annuity $10,000, no matter how much they had in.
Wow, that's scary.
855-935-TALK. That's our phone number, 855-935-8255. And Sandra, it's your turn. Welcome to Talking Real Money.
Hi, guys. I want to put an addition on the back of my house next year, and estimates say it's going to be about $200,000. I have a pension and a 401k, and I've been saving through a taxable account with a fiduciary. Instead of selling off a huge amount of stock and throwing myself into the highest possible tax bracket, I understand that I might be able to borrow against that stock. That can work out or not, depending on market conditions. Can you discuss, for the rest of us, how that works?
Oh, are you talking about like
margin
a
loan? She's talking about a margin
Okay.
loan, yeah.
Why not just like a HELOC or something instead?
Borrow using
That's
equities.
yeah. Well, you can either
Equities
you
as
can
well.
pledge them as security to a bank.
Pledge securities, yeah.
Yeah, or you can borrow through your brokerage firm in the form of a margin loan. Margin loans have an adjustable rate. They can go anywhere. Who knows? But yeah, you could go to your banker and say, I have X number of securities that I will pledge as collateral for a loan. But Tom's question makes, how much equity do you have in your home?
I've got, depending on current market conditions, about $550K.
I would just borrow against the value of the home, either through a HELOC, as Tom said. What's your current interest rate on the home mortgage, though?
2.65.
Oh, great rate. Okay.
Wow. Yeah. But the HELOC is going to be probably double that or so.
4 to
Something
5.
like that. But I would still take that over either a pledged account or margin.
Yeah,
no-brainer.
because a pledged account at a bank is considered a personal loan. You're going to probably end up with a higher rate, depending on your personal relationship with the bank, your credit situation, and the like. You're likely to get the better rate with the HELOC. Although you may want to consider, because rates are still quite low. I saw a 30-year recently at 2 3/4.
Yeah, the last I saw was 3 flat, but okay.
There may be some deals out there. Shop around a little bit, because if you can find a rate that's very close to what you have now, to refi the whole thing, if you can get a deal where the closing costs are low, and one of the places I go to look is through Costco for good deals, because Costco cuts deals with some of these lenders. You might want to just do a new first altogether and roll the addition into the first, because that's going to give you equity back in the home down the road anyway. So I think that'd be the cheapest way to do it personally. You?
Yeah, they said there'd be a huge tax hit if I just basically sold off my equity.
Yeah.
No, we wouldn't be recommending
That's what I'm saying.
that.
There would be no tax hit for refinancing your mortgage, which is going
I get a little worried too when your advisor is suggesting a margin loan, because the other thing about margin loans, it always feels like it's like your snow chains getting wrapped around the axle. It just feels like it gets confusing to people. I don't like seeing them in a general sense, because number one, I don't like to borrow money to invest. Number two, it feels like then it adds a confusing element to your overall investment strategy. I would rather see you either take the equity out of the home the way Don said, or get a HELOC that way, do the rebuild, and then with such a low interest rate, it really makes great sense.
And here's the other thing. The margin loan rate right now at Fidelity is over 7%. The margin loan rate at Schwab is over 8%.
Wow.
So you're going to pay a higher rate, and it's an adjustable rate. So if rates go up, your margin loan rate is going to go up. That's why I think I bet you when you sit down and crunch the numbers, you're going to find the very best deal, even though you're going to have some closing costs, and even though your rate might go up fractionally, that you'll find the best price for the money to be a refi of your first and a cash out for $200,000.
Thank you for your call, Sandra. By the way, if you go through Costco, make sure you get them to throw in some toilet paper and paper towels, which again are in short supply.
No. I'm sorry. I would just go for the rotisserie chicken. Just get a lot of that.
Well,
rotisserie
those are never
chicken.
in short supply, because they got that place in the Midwest. They could producing like 4,000 chickens a minute or something.
4,000 mutant giant chickens.
They are good Actually, that's a good idea. So no, I'd rather see you borrow from the equity there. Yeah, I'd rather see you borrow from that rather than against your investments, put it that way.
Yeah. Thank you for the call. We really appreciate it. 855-935-TALK is our phone number, 855-935-8255. And by the way, just to let you know, Costco doesn't pay us anything for that plug. I've just used them twice for refinancing, and I got such great deals on closing costs.
I did the same. Now, somebody cornered me at our client event in August and said, I went to Costco and it didn't work out, just because you guys should know that, since you always talk about it.
You know what?
It doesn't always work out.
No, things don't always. Things aren't this. Here I'm looking. I just found a rate 2.625.
Wow.
So
30-year?
I think. Oh, that's with points. That's with points.
Okay, I was going to say, because, you got to balance
it's about
that out.
3 without points. Okay. But still, though, if you're going to pay 5 or 6 or 7 on a HELOC, or 7 or 8 or 9 on a securities loan, better deal.
Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Decisions like the one Sandra's facing and that we all face. You face them, I face them. I faced them recently when I refinanced. When do you refinance a home or borrow from your home versus when do you sell things? That really becomes a basic
Sell other assets.
Yeah, that really comes down to a basic numbers thing. You have, as with everything, here's the ready. You're not going to like this if you didn't like math in school. You're going to need to do the math. It's really that simple.
It is, because there always feels like there's an emotional component to a mortgage. One of those things that you hear all the time is don't retire until you pay off your mortgage, or take the money and pay off your mortgage. I know, but it's one of those things that's sort of out there as a rule of thumb. You don't want to have a mortgage in retirement. Well, baloney. I'm going to have one in retirement. I think I've already said this previously, but I'm planning on refinancing not long before I retire and take out another 30-year and spread it all out.
But let me ask you a question. Let me ask you a
yeah.
question about that, though. Think about this for a minute. What if, I'm not saying this is going to happen, I am not predicting anything, but what if a few years from now, when you're thinking about that refinancing to take money out, and we've had...
No, not taking money out, just refinancing.
Oh, refinancing, I'm sorry, yeah.
Yeah.
What if rates have kicked up into the double digits?
You've raised this before. That won't happen. I've already done some checking. I made a few phone calls. Not going to happen.
In Tom's world. Tom's world is a world...
friends at the Fed,
no
bro.
No one else lives in Tom's world except Tom.
That's a possibility. That's fair, because right now my rate is 2.4 or something ridiculous. I mean, I got literally right at the exact moment.
I believe one of the reasons
15-year.
why that was a rule of thumb for people to pay off those mortgages was because there've never been, ever
this is the lowest ever
mortgage rates this low in the history of mortgages. And I'm sorry, that goes clear back to It's a Wonderful Life, way back then.
Before.
The building and loan. Yeah. Oh, before. Yeah. Well, before that even.
Mm-hmm. Yeah. No, so you're right. What if they doubled? What if, let's just say, for example, they're 5. Mm-hmm. And then I said, well, now I don't really want to take a 2.5 and turn that into a 5. So that could be an issue. You're right.
But that's why I'm sitting here going, and I had this, and this is a discussion that comes up in families. I had this discussion with my wife, is why are we taking out, when we refinance, why are we taking out a 30-year mortgage? Mm-hmm. And my thinking is, I am unlikely, not guaranteeing it, but I am unlikely to see mortgage rates a whole lot lower than what they are today.
Well, and to see 30 years. I thought that's where you were headed.
No, I'm not.
I made a phone call on that to make sure that's not going to happen.
I looked at my mortgage because I was making my first payment. I looked at the payoff date.
Don't tell me. Don't tell me.
You'll know.
50, 52,
51,
53.
2051.
Yeah. Okay.
I will be 94 years old.
Okay, well, it's possible.
95. No, I'll be 95
You'll still be in that same
old.
room, too, by the way. You'll still be in that same room with the door right behind you.
So I'll be sitting here on my antique microphone.
That's true.
Don has one of those really antique microphones there.
Look at that
I'll
thing.
be there
Been
going,
around since
hey,
the 20s.
This is a red letter day. My house is paid off. I can die happy.
Yeah. No, I mean, I just, again, you're right. You've got to do the math. It's not an emotional. I'm just going to pay it off because I don't want.
And that's why I say do the math. Go out and get a quote on a HELOC. Find out what they'll do a $200,000 HELOC, and then do the math. What am I going to pay for that HELOC? And the HELOC, remember, will probably be an adjustable rate, not a fixed rate. So count on, just calculate it being a little higher than it is initially.
What is a little, by the way?
I don't know. More than one.
Well, you can't. How can you calculate if you say a little?
Okay, kick it up a couple of percentage points just to see.
Okay, 2.
Yeah.
By when?
Couple. By tomorrow. By day after tomorrow.
By tomorrow?
Okay, 6
Whoa,
months from now.
major announcement on Talking Real Money. Interest rates up
are going
2%.
Anyway, do the rough math. I'm not saying do precise math, but see where that 3% on the 30-year, where you're taking your mortgage up, versus the $200,000 on the HELOC, versus paying 9 or 10% down the road on a securities loan, and see what.
By the way,
differences are.
if it goes to 5, it's an interesting conundrum for me, because it might then make sense to take a chunk of change, pay the thing off. Now I got no payment in retirement. It might work at that point.
Not if you have a 2 3/4 today.
No, that's what I'm saying. If it goes to 5 and I want to refinance it for a longer period of time, then it might make sense.
Yeah, okay, I get it. 855-935-TALK. We've got a line 235 open for you now. Call.
Tom and Don are talking real money.
Set your course for a great future with a free copy of our 60-page Better Retirement Guidebook at vestory.com, vestory.com.
Reality radio for a really great future. We're talking real money.
One more time. Oh, it's not the last time I'm going to mention this. No way. I'm going to mention this a lot. Our phone number, 855-935-TALK, 855-935-8255. Call us.
Now I know you need to work another 30 years to pay off the mortgage. You're going to be mentioning that number a zillion times. Yeah.
So I literally have to work right up until I'm 95
exactly.
to pay off the mortgage. So
I talked to somebody yesterday who was still fixing barometers at age 94. The mercury ones.
People still have mercury barometers?
Yeah.
Really?
Those are getting kind of old. Yeah. Anyway.
Well, yeah, they date back to like Euripides or something. I just made up names. Yeah. I just threw that out. I have no idea. Eurythium. That's Tom's name. Hey, there is something that has baffled me. This baffles me constantly. Let's take some of the big fund groups, mutual fund companies out there, like Vanguard or Fidelity. Big, well-known, household names, fund groups with a lot of great mutual funds, index mutual funds, indexed ETFs, really truly passive products with great expense ratios, really good for their clients, really good stuff for their clients. And it baffles me.
On the other hand?
Yeah, on the other hand, it baffles me, particularly with Vanguard, but with Fidelity too, given the success that they're enjoying with their index funds. Why they continue to both create and promote actively managed mutual funds for which it is almost impossible to find any evidence of outperformance that would justify their fees.
Now, be careful. When you say outperformance, you
outperforming
mean
their benchmarks.
Right. So you said, okay, the S&P 500 has made 10. This fund has made 9.5.
Right. This is a large cap growth fund or large cap blend fund, and it's underperforming the S&P 500 because it has an expense ratio of 0.7% a year.
And in fairness to Fidelity, of course, the firm started as stock picking fund. That's where that's their home. That's their base. That's where they came from, right? Vanguard, on the other hand, really was started with the indexing in the early 70s. They had
Wellington was the active management from Wellington Management was sort of the basis for the company. But the reality is Vanguard enjoyed the bulk of their great success and their name on the back of index and passive. But Fidelity, though, chose to attack that niche with a vengeance because a couple of things. One, there's a lot of money there so that you get economics of scale and you don't have to work very hard, so you don't have to charge a lot. And yet they still continue to crank out and recharacterize and move and play games with their active funds.
And you're asking why?
Well, because so they can make more money, I'm sure.
Oh, really?
I'm looking at some of these
cynical.
I'm looking at some of these Fidelity funds, like the Fidelity Advisor Energy M Fund, has an expense ratio of 1.4% per year. Really?
How many stocks?
I don't know. You mean I have to look that up?
Well, I was just curious.
Well, here's
because
one that's going to have more stocks. The Fidelity Advisor Growth Opportunities Fund, which is 1.3%.
Wow.
I'm going to look up how many stocks, but
not very many funds, hopefully, that they have that are over that amount.
I don't get this stuff. Anyway, we'll talk more about that in a minute. 855-935-TALK is our phone number, 855-935-8255. Arlen, you're up. Welcome to the program.
Hey, how are you doing?
Good. How are you?
Good.
I got a question that kind of doing all right. It goes a little bit along the lines of what you guys are talking about. We're about 1 to 2 years from retirement, and we've got an investment property, and thinking about selling it in the least, and paying the least amount of taxes possible. And so what we had in mind was to, sell the property and take the cash and put it immediately into, say, our retirement home. Buy another piece of property with the cash so that you don't have to take the taxes on it. Did a little research on it and just kind of starting into the research, and it seems to say that in order to avoid the taxes, you have to purchase a property of the same value of the one you sold with the same amount of mortgage that you had on the previous one. Does that make any sense to you?
You're talking about a 1031 exchange.
Yep.
Has to be a like property.
Yeah,
I didn't know about I didn't know you have to own as much.
I always thought that the qualifier was a like property. I don't believe I ever found anything that said exactly the same price. But hang on a minute. We've got to take a break. We have to do this on time, and we will talk about this because it's a good topic. 855-935-TALK is our phone number, 855-935-8255.
Tom and Don are talking real money.
A second opinion could save your life either physically or fiscally. Let one of our Vestory advisors help you save your future at Vestory.com, Vestory.com.
For your real life and real future, Tom and Don are talking real money.
Hey, hi, welcome back. I'm Don. Tom's over there. We're talking money with you. We're talking money with Arlen right now, who has a piece of property, and he'd like to do what is called a 1031 exchange. It's a like-kind exchange to avoid taxes on investment property. And Arlen, before I know what you're talking about now with the prices and the mortgage, but is the property that you have now that you want to 1031 exchange, is that an investment property?
It is.
You've rented it out.
It's a rental house.
Okay, good. Just you have to have rented it out. That is critical. The thing that you're talking about is boot. If you were to take your property and exchange it for a like-kind property that was worth less than the property you have now, you would have a taxable boot. Same thing applies to mortgages. If you take out a mortgage that is less than the mortgage on the current property, you could have boot there. This is a really complicated law, and it also requires an intermediary.
Yeah, you got to have somebody else to work with you on it.
Because somebody has to take the money. Okay, you got that part? Okay. So really, if you get a property that's higher value, same or higher value, you're going to be fine. If you have a mortgage that's the same or higher, you'll be fine.
Yeah, see, the thought was we were hoping to say, cash out. Basically sell the house, take the cash, put it in a lesser value property and not have a mortgage.
Yeah, you can't do that.
But the funky law
Well, you can do it.
You're going to get taxed if you do that.
You're going to get taxed if you do it.
You're going to pay the tax on the gain that you had in that property.
Actually, the fact that an exchange even exists shocks me. I would be willing to bet you'll see that eventually go away.
It's on the list of things that may get axed in this new tax bill.
And that whenever you sell an investment property, you will just pay the capital gain.
You'll just get taxed.
Yep. Okay.
Turns out the government's running light. They're looking for new revenues.
Yeah, they're looking for your dough there, Arlen. Thanks for the call.
Looking for my money.
They want yours.
Exactly.
Thank you, sir. Take care. Gretchen, you're up next. Welcome to Talking Real Money. Hey, Gretchen.
Gretchen dropped.
Oh, no, Gretchen. We lost you, Gretchen. Thank goodness we have Rita to take her place. Thank you for stepping in, Rita. Welcome to the show.
Hello.
Hi.
Hello.
Hey.
Thank you. I've listened to your show for a couple of months now, and I'm a new investor.
Woohoo.
And I would like to know where I should start to get the information. I'm 60 years old, have a Roth IRA, and also a mutual fund with my husband, but trying to get some money for retirement in the next 5 or 8 years.
Well, oh, wait, you say you're looking for a place from which to get information? Don't you already know the answer to that question?
Well,
You're listening
you
to it
guys,
now.
and
Okay.
Okay, but I mean, the question is what sort of information? Because even on our website, we give you 3 mutual funds or exchange traded funds you could use with your Roth IRA. Pretty simple. I don't. Are you looking for like retirement planning? What sort of information do you need?
Yeah, retirement.
Planning. Okay. Yeah. Do you have you ever worked with an advisor before?
Yeah, I worked with Edward Jones.
Oh yeah, no, that's not an advisor. That's Edward Jones. That's a broker.
Yes.
That's a stockbroker. They're not an advisor. They may say they are.
And then we lost money with New York Life Insurance when they.
They're defaultly not a financial advisor. They're an insurance company.
That was terrible.
Yeah. Here's the thing. There's this little trick, and it's a trick. You got to find somebody who's honest. It's so hard to do. I'm not just honest, but impeccably honest, because to say Edward Jones is not honest isn't really true. They just don't act in your best interests all the time. And they're not big fans of disclosing everything. They don't like to tell you all the fees and commissions you pay because you're going to think, well, wait, that's too much. I don't want to pay that much. So the trick is to find a true fiduciary advisor, a true fiduciary. And we give you the tools to do it at Talking Real Money. We really do. They're free. Go to talkingrealmoney.com/info.
I thought it was help.
Oh, help. Wrong one. /help. I'm sorry. I'm getting old.
Making it harder.
I'm not even 95 yet, and it's already happening.
TalkingRealMoney.com/help. HELP. Just like the Beatles album.
You will not believe the amount of stuff there that'll help you find an advisor. Okay.
All right. So start there and just follow their advice.
That's our advice, yes. And follow that. And then, of course, listen to Talking Real Money every Saturday.
Keep saving.
Como, and listen to the Talking Real Money podcast. And then if you get really, really bored, go watch us on YouTube.
There you go. Can you just tell me thumbs up or thumbs down about Charles Schwab?
We love Schwab. We love Schwab as a custodian, but we would not go to them for advice.
Okay. All right, great.
Okay.
Thank you very much.
You're very, very, very welcome.
Bye.
Thank you. Bye-bye.
Yeah, I mean, the thing about Schwab is it's not independent advice, and it's not always fiduciary advice. Not always.
Yeah,
so,
and they do have
confusing.
a lot of advisors with whom they work, but really the trick is there are a few tricks to finding a true fiduciary advisor. Now, but bear in mind, I hate to say this, it sounds like I'm always curmudgeonly, but when money's involved, people lie.
Truth hurts. Yeah.
They lie. They do.
They'll do anything. I think our friend Paul Merriman once said they would crawl across cracked glass for an account.
Yeah.
And
if you were to call, there is a well-known, and I'm using air quotes here on the radio, so I have to tell you they're here, financial advisor, well-known financial advisor in air quotes, who's on TV and was on the radio in the Seattle area for a long time. And you could call his office, and he's a CFP. Certified Financial Planner. Woo! You could call his office and say, "Are you always a fiduciary?" And you know what his people are going to tell you?
Of course. Absolutely. You bet. We are. Yes.
But they'd be lying when they said that because this firm sells equity indexed annuities. But when they sell those, they're not selling those in their capacity as a fiduciary. And this is a loophole that the federal government should not allow to exist. There should be no way you can be a fiduciary and not a fiduciary at the same time.
But they are, and they're duly registered as both a fiduciary and as a broker-dealer, therefore putting you at risk of being pushed into one of those products that are horrible.
So what do you do if they lie verbally? What do you need to do? What do you do? Let's say you've got a verbal agreement with someone to buy something, and you're not sure they're going to follow through. What do? You create a written contract.
Yeah.
That's what you need. I hate to say this, but in this industry, that's what you need to do. You need to have a written contract that says, I attest that I will always act as your fiduciary and in your best interests. Now, to make that easier for you, if you go to talkingrealmoney.com/help, I have created a 2-page colored form, so it's got color-coded boxes into which your advisor can enter information. Tell you about
if they are a 100% full-time fiduciary advisor, they will have no trouble
none
filling it out and signing it.
None.
But if they're not, then guess what? They might say, oh, my compliance department doesn't. My manager says I can't sign this.
Yeah,
Who wrote this
legal
thing
department.
anyway?
They won't let me sign this thing. I mean, the other thing you do is just put it on a piece of paper. I, so-and-so, guarantee that I will always act in your best interests and as your fiduciary, signed the broker, the advisor's name. But they won't sign that either. They won't if they're liars. So I guess that's a good way to flush out the liars, huh? Thanks for being there. Go to talkingrealmoney.com.
Tom and Don are talking real money.
Tom and I created Vestory to help everyone become a better investor, even those who will never be clients. Let one of our advisors help you start your financial plan or solve a money problem free with no obligation or high-pressure sales pitch at Vestory.com. Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
In fact, at talkingrealmoney.com/help, we also have a list of advisors in the Seattle area that we happen to know are 100% fiduciaries. We just know they are. Now, we're not telling you they're the best advisors. That we can't tell you. We just know they're fiduciaries. But one of those on that list is us, because we know we're fiduciaries. Tom and I started Vestory several years ago and to help people manage money because we realized a lot of you don't do it well. But the other thing we decided to do was provide fiduciary help to anyone who asks us at no cost or obligation for a limited period of time. We're not going to manage your money for that. That's bad business. It means we go broke and then we can't work for you anymore. But we will do it for free. We'll answer your questions, help you get started on a plan. You can meet with one of our advisors for free for nothing and with no high-pressure sales pitch by setting up an appointment at Vestory.com.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestory, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures. That's a wrap.